Welcome back, Loud and Wealth Club, to another episode of the Loud and Wealth Club podcast. We have a good one for you today. Let's make sure you guys are liking, sharing, and most importantly, subscribing as we're trying to reach 2,000 subscribers. So help us out with a simple subscribe. Also, check out our website, loudandwealthclub.com, where I post articles on finance and politics. See how you could capitalize off these new policies that the Trump administration is introducing to government. But with that being said, this is your host, MP, behind the scenes.
Easy.
What's up, bro? How you doing?
Good, bro. How about you?
You feeling blessed?
Feeling happy for sure.
I'm feeling blessed, bro. I look at my crypto account. That's amazing. So if you guys are interested in learning about crypto, head over to the Bull Room. That's a series where we talk about investments like stocks, crypto, real estate. As of right now, we're really focused on crypto. So if you want to learn about that, make sure to check out some of those episodes. But today, bro, I want to talk about these interest rates. We're going to be down a whole point before 2025. From what it looks like, even though CPI is getting a little sticky in the words of AZ. But as of right now, we're already down 0.75%. Let's talk about how this impacts us, how this will impact the everyday American, just in general, right? And I also want to talk about the timeline, sequence, and what to look out for as investors, as business owners, or just everyday civilians, right? But we have to understand why interest rate cuts happen and what's their purpose. So they happen when the economy is not looking too good. When the economy is not looking too good, they cut interest rates in order to stimulate economic growth with printing new money, with pretty much just introducing new money into the system and letting it circulate, pretty much putting more into the supply, hoping the demand will rise. So we're going to talk about the immediate effects of a interest rate cut, and the immediate effects aren't really too crazy, right? The cost of borrowing money goes down, so you might see businesses taking out business loans to invest into their companies. You might see people getting new cars, new mortgages, or just taking out personal loans just because, like I said, the cost to borrow money is now cheaper. And then financial markets tend to go up. They tend to react to interest rate cuts because they know that business investment will be coming. More businesses are going to be taking out loans. They're probably going to want to invest in other companies or in themselves. So, a lot of investors are going to want to put money where companies are going to be putting money, right? Either in themselves or either, in different companies. But in the short term of, the interest rate cuts, we're talking about 3 to 6 months, we might see a increase, right, of consumer spending as, again, interest rates are typically low. People have some cushion. People want to spend more money. We might see an increase in home and auto loans in the short term. And like I said, business investment, right? Businesses are going to be taking out loans to expand their workforce, expand their company as a whole. And then, we're going to talk about the midterm effects, right? The 6 to 1 year mark. Labor markets usually get impacted by this time. As businesses already took out those loans, they start to expand and create jobs. And also, there might be some wage growth, right? Companies might be offering some positions, higher paying wages, or just bonuses across the board for their company. Now, because of consumer spending probably ramping up, we might see a tick in inflation just because, the demand of things are going up. So they're going to be like, hey, our supply is going down. We're going to have to raise interest, a little bit on, the product, to bring more profit in and stuff like that. I said interest. Tick it up, increase the price, right? Causing some inflation. So we might see some inflationary pressures. And I think that's going to be something to watch for as the Fed will be keeping a nice, a good eye on that. But if anything, I don't think they're going to, increase rates. If anything, they're just going to hold them steady until, you could say like the dust clears away. But in the long term, we're talking about 1 to 2 years, there's just broad economic growth just all around maturing. Right, so we're going to see in the 1 to 2 years, we're going to see a lot of, companies growing. We're going to see probably new all-time highs for the stock market and crypto. And, just interest-sensitive sectors like technology, manufacturing, which rely on capital to expand, they're probably going to see more wage growth and more literally job growth, right? We're going to see America expanding. Again, also bank lending policies will probably get deregulated by the Trump administration, causing, people to take out loans a lot easier than, it was before. Now, what could affect, more rate cuts again would be consumer spending. So let's keep an eye on that. Also, business confidence. If businesses, start to be a little, not confident about the economy, they're not going to be spending or circulating money around the economy as much as they would with, a little bit more confidence. So consumer spending and business confidence is going to be something we're going to look forward, keep a close eye on. Also, supply chain issues. If we have, I don't know, per se, another COVID, that could probably affect the interest rate cut. But I don't think that's going to happen. But other than that, it's just a simple overview of the interest rates and how they impact us, short term, middle, and long term effects of it. But, just to call it as it is, this is a good thing. The economy is going to grow. People are going to make a lot of money. The Trump administration is going to allow you to keep most of that money. It's just the question here is going to be, how do you prepare when the inflation does tick up in a couple years? Are you going to be prepared? Are you going to have your investments ready? Are you going to have your savings ready? Who knows, right? As for me, I'm going to be preparing for 2027, 2028, when I believe inflation will tick up a little bit worse than these times that we just got out of. So if these times were hard for you, be prepared for worse. But with that being said, all money in, no money out. Stay dedicated, stay motivated, and we'll see you on the next Milano Wealth Club. Don't be a little bitch, and make sure to prepare for those future inflation pressures because it's going to get bad, guys. It's going to get bad.